This is Dave. Dave just bought his dream house, and in exactly 3 minutes, I'm going to ruin this moment for him. Sorry, Dave. Dave did everything right. Steady job, good credit, saved for years. The banker even shook his hand twice. He signs the mortgage. 30 years. Dave doesn't even blink. 30 years sounds like someone else's problem. Dave imagines himself 30 years from now, mortgage paid off, sipping lemonade on a porch he fully owns. Here's the problem. That porch lemonade guy, he's not who the mortgage was actually built for, because your 30-year mortgage wasn't designed to build your wealth first. It was designed to collect the bank's interest first. Let me show you. Dave thinks, pay the mortgage, chip away at the house, done. Simple math, right? Except mortgages don't split your payment evenly. They front-load the interest. Dave has never heard the word amortization in his life. So Dave opens his laptop and pulls up his own amortization schedule. His face slowly changes. Year 1. Dave pays $12,000. Almost $9,000 of it goes straight to interest. Only a sliver touches the actual house. Dave blinks at the screen like it insulted his mother. Year 5. Dave has paid the bank $60,000. He owns barely a bedroom's worth of house. It's like running on a treadmill and calling it a road trip. Lots of motion, very little arrival. Here's the twist. It's not a scam. It's just math. The bank takes its interest early because early is less risky for them, which means the first 10 to 15 years of your mortgage are basically rent. Rent with extra steps. Dave sits back in his chair. The dream porch is looking a lot further away than year 30. But wait, there's more. Dave gets a letter in the mail. It's not from a friend. PMI Private Mortgage Insurance. Dave didn't put 20% down, so now he pays extra to insure the bank, not himself. $200 a month. For nothing Dave gets to keep. It just protects the lender from Dave. Dave laughs a sad little laugh, the kind you laugh when crying feels like too much effort. Then property taxes go up. Then insurance goes up. Dave's fixed payment is doing anything but sitting still. Dave checks his escrow account. It's short. Somehow he owes more, despite paying on time every single month. This is the part nobody warns you about at closing. The bank hands you the keys and quietly keeps the map. Dave starts wondering if homeowner is just a fancy word for very long-term tenant. Then rates drop. Dave's coworker says the magic word, refinance, lower payment. Dave's eyes light up. Dave refinances. His new monthly payment feels great. He does a little victory dance in his kitchen. Nobody tells Dave the quiet part. Refinancing often restarts the clock. Back to year 1. Back to mostly interest payments. Dave just traded 7 years of progress for a smaller number on a piece of paper. It's like running a marathon, getting close to the finish line, and someone moves the finish line back to the start. Dave sits down slowly. The victory dance is officially over. This isn't Dave being dumb. This is Dave being human. The math was never explained. Only the monthly number was. And that's exactly the point. Nobody sat Dave down and said, the length of your loan is a decision, not just a default. Let's talk about the money Dave isn't seeing. The money that could have grown somewhere else. If Dave had invested the difference between a 15-year and 30-year payment into a simple index fund over 30 years, that money could have quietly become worth more than the house itself. Dave imagines a version of himself in a parallel universe, sipping lemonade a decade earlier. That guy looks smug, The 30-year mortgage isn't evil, but it is optimized for the bank's cash flow, not Dave's freedom. Banks aren't hiding this. It's all in the fine print. It's just a lot of fine print. And humans, famously, do not enjoy reading fine print before free house keys. Dave squints at his loan documents. 42 pages. He signed page 42 faster than he read page 1. Okay, enough doom. Let's fix Dave's situation. Because there are ways out of the slow lane. Fix 1. Extra principal payments. Even $50 extra a month chips years off the loan. Dave circles the word principal on his statement like he just found a cheat code. Fix 2. Bi-weekly payments instead of monthly. Same money, different rhythm. Sneaks in 1 extra payment a year. Dave sets up the bi-weekly plan on his banking app. 1 tap. Future Dave says thank you. Fix 3. Before refinancing, always ask, does this restart my clock? If yes, do the math first, not after. Dave writes this on a sticky note and puts it right on his laptop. A tiny act of rebellion against fine print. Fix 4. Request PMI removal the moment you hit 20% equity. It doesn't cancel itself. You have to ask. Dave picks up the phone to call his lender. He looks nervous, then determined, then he actually dials. Small moves, not magic. Just Dave finally reading the map the bank quietly kept. A few years later, Dave checks his amortization schedule again. This time more of his payment hits the house. He smiles. Not a big smile. A small, I finally understand my own money kind of smile. Dave isn't rich. Dave isn't a genius. Dave just stopped assuming the bank was rooting for him. The 30-year mortgage isn't a trap because it's evil. It's a trap because it's misunderstood. And the moment you understand it, it stops being a trap and starts being a tool. Dave sits on his porch, not year 30, just a random Tuesday. And it already feels a little more his. So before you sign anything with your name and 30 years next to it, know what you're really signing up for. That's the mortgage trap nobody explains at closing. If this saved you from your money mistakes, subscribe to Leaky Wallet so you don't miss out on our other videos. Do this before your money leaks out too.